Are you ready to unlock the secrets of real estate wealth? Welcome to our 3-part real estate investment series. Over the next few weeks, I'll guide you through proven strategies to grow your money with property. Today, we're starting with rental properties, discovering how they generate cash flow and how to measure success using return on investment, or ROI. This global guide applies wherever you are, so let's dive in. So, what exactly is ROI in real estate? Think of it as your scorecard for how much profit a rental property earns compared to your overall investment. We're not just talking about rent minus a mortgage. This includes maintenance, property taxes, management fees, and even furniture depreciation if the unit is furnished. Whether you're using rental income to cover everyday expenses, fund a dream lifestyle, or pay off a loan, knowing your ROI tells you if the investment is worth it. Let's break it down further. Now, let's explore the different types of rental properties and how they shape your ROI. There are 4 main categories, each with its own mix of costs and returns. First up are unfurnished units. These are basic properties. No furniture is provided, so tenants bring their own belongings. The benefit here is a lower initial investment and minimal upkeep costs, which means steady, long-term income even if the rent isn't as high. Then, there are partly furnished units. In these, you provide a few essentials like a bed, sofa, or fridge. This slight investment lets you command a bit more rent, striking a balance between cost and increased income. Next, we have long-term furnished rentals. These properties are fully or mostly furnished, perfect for professionals or expats looking for a move-in-ready home. Yes, the upfront costs are higher, considering both the quality and depreciation of furnishings. But you can charge a premium. Rent often 20 to 40% more than unfurnished properties. Lastly, there are short-term furnished rentals, like vacation homes or Airbnbs. These properties can earn top dollar on a nightly basis, though they come with higher operational costs for cleaning and management, and the income can vary with seasonal demand. All right, let's talk numbers. The foundation of analyzing a rental property is its net operating income, or NOI. Think of NOI as the money you actually keep from rent after covering all operating expenses, like property taxes, maintenance, and management fees. But before, your mortgage or income taxes come into play. For example, imagine your property earns $2,000 per month. That's $24,000 a year. Now, let's say your annual expenses are $2,500 for property taxes, $800 for maintenance, $2,400 for management fees, and $2,900 for utilities and insurance. In total, that's $9,600 in expenses. When you subtract those costs from your rental income, you get an NOI of $14,400. Now, to calculate ROI, you divide that NOI by your total investment, which includes the purchase price, closing costs, and any upgrades, and multiply by 100. So, if your total investment is $200,000, your ROI would be $14,400 divided by $200,000 times 100, or about 7.2%. This means your property is generating a 7.2% return each year, which is pretty solid for rental investments. Here's a neat trick to see how your investment grows over time: the Rule of 72. It's a quick way to estimate how many years it will take for your investment to double. All you do is divide 72 by your annual ROI. For instance, with a 7.2% return, 72 divided by 7.2 gives you about 10 years to double your money. If your ROI is lower, say 3%, it would take around 24 years. And with an 8% ROI, just 9 years. This rule isn't only great for tracking investment growth, it also helps you understand how inflation works. At 3% inflation, your money's buying power halves in about 24 years. It really shows why even a small difference in ROI can have a big impact over time. At the end of the day, your choice of rental property should match your personal financial goals. Maybe you're after steady, predictable income, Unfurnished or long-term rentals might be the way to go. Or perhaps you're excited about the potential for higher returns, and short-term rentals could really boost your cash flow, even though they require a bit more work. And trust me, later in the series, I'll share some creative, low-capital strategies to break into real estate. For now, it's all about matching the right strategy with what you want to achieve. Did you know that real estate has outperformed the stock market over the past 50 years, delivering an average annual return of around 10%? That's because capital gains, when your property appreciates in value, can supercharge your investments. Welcome back to our real estate investment series. In episode 1, we broke down ROI on rental income. Today, we're shifting focus to capital gains, the profit you make when your property's value increases over time. Understanding capital gains is essential because while rental income keeps your cash flow steady, capital gains build your wealth more rapidly. Investors often face several challenges when evaluating capital gains. How do you accurately calculate the appreciation of your property after accounting for taxes? What impact does investing in a furnished rental have on your overall returns? Remember, if you buy a property to rent it out furnished, the cost of the furniture is a capital expense that depreciates over time, unlike when you buy a home solely for personal use. And how do property types, unfurnished, partly furnished, fully furnished for long-term or short-term rentals, affect your ROI? Additionally, market trends, tax implications, and location-specific factors add layers of complexity. For instance, buying in an up-and-coming area might yield significant capital gains, but there are risks like market uncertainty, infrastructure issues, or overcrowding to consider. Let's break down the calculation for capital gains. Remember, most countries impose a capital gains tax on the profit you make. The formula is as follows. Capital gains ROI equals, open parenthesis, final sale price minus initial purchase price minus capital gains tax, divided by initial purchase price, close parenthesis, multiplied by 100%. For example, if you buy a unit for $200,000 and sell it for $300,000, the raw capital gain of $100,000. However, if the government charges a 20% capital gains tax, you must subtract $20,000 from your gain, resulting in a net capital gain of $80,000. In this case, your adjusted capital gains ROI is calculated as $80,000 divided by $200,000 multiplied by 100%, which comes to 40%. Also, if you're operating a furnished rental, the cost of quality furnishings, while a capital expense, depreciates over time and must be included in your overall calculations, unlike if you're simply buying a home for personal use. Another powerful tool is the Rule of 72, which estimates how many years it will take for your investment to double, assuming a steady, linear annual return. The rule is stated as years to double equals 72 divided by annual ROI. For instance, if your capital gains ROI is 10%, dividing 72 by 10 suggests it will take about 7.2 years to double your investment. With an 8% ROI, it's roughly 9 years. However, be aware that property appreciation isn't always linear. A property might appreciate 10% in the first year, but 20% in the second. So this is a simplified estimate. Other examples include a 5% ROI, which gives you about 14.4 years, and a 12% ROI, which suggests only 6 years to double. To grow your real estate portfolio quickly, focus on maximizing capital gains by getting in early on promising opportunities. Consider these strategies. Raw land purchases. Buying land in areas where new roads, malls, or business centers are planned. Off-plan unit investments. Purchasing properties before construction begins to lock in a lower price. Investing in up-and-coming neighborhoods. Target areas that are beginning to see development, where a surge in demand is anticipated. Pre-development opportunities. Acquiring properties or units in anticipation of future development that can drive up value quickly. Each strategy has its risks. For example, purchasing raw land or off-plan units might feel like gambling if the expected development never materializes. Also, factors such as market crowding or poor infrastructure, like insufficient roads or public transport, can slow down property appreciation, even in areas with development surges. Here's the key insight. To truly understand your property's performance, you must combine both your rental income and capital gains into one comprehensive ROI calculation. Start with your total capital investment, which includes the purchase price plus any capital spent on furnishings for rental units and any replacement costs incurred during the period. Next, determine your net operating income, or NOI, by subtracting all operating expenses from your annual rental income. Then, evaluate your capital appreciation by comparing the current market value of your property to your initial purchase price. We calculate the comprehensive ROI by saying, comprehensive ROI equals, open parenthesis, market value minus initial investment plus net operating income, divided by initial investment, close parenthesis, multiplied by 100%. For example, imagine you purchased a property for $200,000 and its market value rises to $300,000, yielding a raw capital appreciation of $100,000. If the property generates an NOI of $14,400 per year, your combined return is calculated as follows. Add $100,000 and $14,400, divide that sum by $200,000, and then multiply by 100%. That gives you an overall ROI of approximately 57.2%. Now, if you decide to realize your gains by selling and are subject to a 20% capital gains tax on the $100,000 gain, you would subtract $20,000 from the gain. This adjusts the capital appreciation to $80,000, and your comprehensive or adjusted ROI becomes adjusted ROI equals, open parenthesis, net capital appreciation plus net operating income, divided by initial investment, close parenthesis, multiplied by 100%. In this case, 80,000 plus 14,400 divided by 200,000 multiplied by 100% comes to approximately 47.2%. This comprehensive formula gives you a full picture of your property's performance, capturing both steady rental income and the potential for rapid capital appreciation. To recap, capital gains are a key driver for rapid portfolio growth. By accurately calculating your capital gains, factoring in capital gains tax, and including expenses like furniture and rental units, you can make better informed investment decisions. Using tools like the Rule of 72 gives you a rough timeline for doubling your investment. But remember, real-world returns can be non-linear. And when you combine your rental income with your capital gains, you get a true picture of your property's performance. Did you know you can start investing in real estate with as little as $1,000? Forget the myth that you need a fortune. Smart, innovative, low-capital strategies can unlock property ownership and get you into the market fast. Welcome to episode 3 of our real estate investment series. Today, we're revealing the secrets to jumpstarting your property journey on a budget. Whether you're an experienced investor or just starting out, get ready for actionable tips to build a profitable portfolio without breaking the bank. Let's start with cooperative financing. By joining a SACCO or credit union, you become a member and save regularly. A credit union is a member-owned, nonprofit cooperative financial institution. Normally, only a member of a credit union may deposit or borrow money. These not-for-profit institutions multiply your savings, funding you a loan at competitive rates. Unlike banks, any surplus funds are returned to members via dividends, lower fees, or enhanced services, and you can even generate extra income through loan interest or reinvested savings. Once you secure the loan, target an almost ready or turnkey property so you can start earning rental income immediately to pay back the loan. And if your credit union offers moratoriums, you can flip a property during that period, resell it at a higher price, pay off the loan, and pocket the difference. Alternatively, use that money for master leasing. Cover the first few months of rent and the capital expense for furniture, then sublet the unit as a short-term stay on platforms like Airbnb or VRBO. You can even opt for a rent-to-own setup. In a rent-to-own transaction, the tenant pays towards purchasing the property at a fixed price within a specific period of time, where every payment you make goes toward owning the property, all starting with minimal savings and low-interest loans. Next, let's dive into master leasing, a real hack for entering real estate with little money. Master leasing is a strategic approach where a tenant, known as the master lessee, secures a long-term lease on a property from the owner. With master leasing, you lease an unfurnished unit, then furnish it as part of your capital investment, optimally setting it up for short terms. Rentals like Airbnb. By securing a long-term master lease, you can sublet the unit as a short-term stay, often the most profitable in ROI terms, to generate rental income that covers your lease payments and earns a profit. But here's the catch. To maximize your returns, you need to build a network of short-term rental units over time. The more properties you sublease, the faster your money compounds. This compounding effect lets you create a fund to eventually purchase some of these units, reducing your overhead as you transition from renting to owning. However, there's a strategic balance. While high ROI on short-term rentals helps you expand your portfolio quickly, when you're ready to buy your first unit, you might be better off choosing a property in a market with high ROI on capital gains. That market might not be the same as where you master lease, so you'll need to scout for properties that attract high capital gains, as discussed in Part 2. In short, your short-term rental profits compound to fund rapid portfolio growth, setting you on a fast track from 0 to 100 in property ownership. Another effective strategy is to leverage low-deposit, low-interest mortgages. Many government-backed or institutional programs offer down payments as low as 3% to 5%, making it possible to purchase fully built, ready-to-rent turnkey properties without a hefty upfront cost. The key is to select properties that meet these programs' criteria and have enough savings to cover the down payment. This ensures that the rental income not only covers your mortgage repayments, but also leaves you with a margin, delivering immediate, stable cash flow. Lastly, there's a modern concept to consider: blockchain fractional ownership. Blockchain fractional ownership enables property owners to divide their assets into tokenized shares. This innovative model lets you buy small fractions, or tokens, of a property, offering an almost zero money entry point. It's a digital gateway into real estate that allows you to diversify your portfolio while you build capital for full ownership. Keep in mind that shared ownership doesn't grant full control immediately, so view this as a complementary strategy until you're ready for traditional ownership. Although developments offering this are rare, when available, they provide an incredibly low entry option. To maximize these strategies, combine them with smart property sourcing. For cooperative loans and flip strategies, look for properties through wholesale purchases, auctions, underpriced listings, or off-plan opportunities that offer lower prices and higher profit margins. When considering master leasing, focus on properties in areas with high rental ROI. Low deposit mortgage strategies work best with turnkey properties, while blockchain fractional ownership is limited to tokenized listings. Together, these approaches allow an investor with modest income to progressively accumulate the capital and equity needed for full ownership and passive income. In summary, whether it's cooperative loans, master leasing, low deposit mortgages, or blockchain fractional ownership, there's a pathway for every investor to break into real estate affordably. These strategies let you start small, compound your returns, and rapidly grow your portfolio. If you found these tips helpful, please hit the like button, subscribe to our channel Thought Trek for more videos like this, and share your thoughts in the comments below. Check out our other videos in our Knowledge Vault to learn about history, controversy, wealth, and many more topics.